So we saw how many originators that we have here today. We saw how many real estate professionals. How many settlement or title companies do we have represented here today? A few. Very good. There's one other class of people we need to find out about. How many of you will consider new employment in a new field come August? There you go. I'm with you. So I have to put this little background bio up here for you because I want to make sure everybody is very clear. I was not the opening act for the Rolling Stones on Sunday. Nor did I play for the Washington Redskins and was drafted in 1984. So I'm 30 plus years in the business. I'm Chief Operating Officer at Sierra Pacific. I have compliance, technology, and operations reporting up to me. And this is a very, very important part of our life, what I'm going to talk to you about today. So everybody has a legal disclaimer, and this is mine. I want to start by saying I am not an attorney. Notwithstanding the foregoing, this workshop is presented with a word of caution. This presentation may cause restlessness, nausea, dizziness, or blurred vision. Some humor may or may not be present, some may laugh, and some may actually cry, based upon the information I'm going to present. The opinions expressed here are solely mine or my wife's, not necessarily those of my employers, past or present, or my friends or those fanatical fantasy football partners of mine. This presentation is subject to change without notice and is void where prohibited by law. No animals were harmed in the making of this presentation, especially my dog Sadie. If this presentation lasts more than 4 hours, please seek immediate help. So, this regulation was passed about 15 months ago. Since that time, I've attended three workshops put on by the Mortgage Bankers Association of America, as well as the American Land Title Association. I've attended an all-day workshop put on by one of our Washington, D.C. legal firms. I've attended countless online webinars. I participate in a conference call with peers every 2 weeks on this subject. And every conference, every event, every presentation I look at, read, and digest, I learn something new. This really is a very complex regulation that's going into effect, and it's going to take some time for the industry to absorb it. So what I'm going to do today, I'm going to move through this presentation rather briskly. I want to make sure we have plenty of time for questions at the end because there will be plenty of questions. Most of which I will be able to answer. Those that I cannot, I will refer to the CFPB, who will respond to you at your next audit. We're going to cover 4 aspects today. We're going to look at the rule overall in general. We're going to look at the 2 new forms, one called the loan estimate, and how that impacts our origination process. The closing disclosure, and there's another rule. Loans originated prior to August 1st fall under the old disclosure documents. Why is there a change? It's really been directed by our friends Christopher Dodd and Barney Frank with the Dodd-Frank law, and it was put into effect by the CFPB. They spent over a year doing extensive industry outreach, outreach to consumers, and once they put the regulation together, they actually did consumer testing on over 800 consumers, who all found that the disclosures actually do present a better, clearer picture of the transaction and the costs involved in the transaction. So it's easier for the consumer to locate some key information about the loan and the process. What's changed? Several key areas have changed. First, there's a new definition of loan application that we'll go into. It combines the initial GFE that we know and love today, the truth in lending disclosure, into a single document called the loan estimate, or LE. It combines the final truth in lending disclosure and the final HUD-1 into a new document called the CD, or closing disclosure. There are new timing requirements around issuing both of those documents. There are new tolerances or variations around the costs and the fees. And the creditor or lender, and I'll kind of use those interchangeably today, has greater responsibility for both of these documents. So what loans are impacted? Almost all closed-end first and second mortgages. It covers consumer construction, construction of term and vacant land loans. It does not apply to HELOCs, reverse mortgages, mobile home loans which are not attached to real estate, and it does not apply to certain down payment assistance seconds where there's no principal or interest payments and the loans are forgiven over time, partially or in whole. Under the rule, the application has been defined now as receiving 6 pieces of data. Once you have the consumer's name, their income, their social security number, property address, an estimate of the value of the property, that's not an appraisal, just somebody's opinion, and the loan amount they need, you are now required to issue the loan estimate. Today we have a 7th catch-all type of requirement that every lender can self-define, so it gives us greater flexibility today about when we have to issue our GFEs. Under the new regulation, we lose that flexibility. So once you receive those 6 items, you now have to issue the loan estimate. And this applies to both the lenders and the mortgage broker. So the pre-application disclosure opportunities, typically when you're talking to buyers and doing a pre-qualification or a pre-approval, they want to know what the costs are. You can still use a worksheet to provide those costs so they can see what the costs are and what the down payment is going to be. But it cannot look or resemble the loan estimate in any way. And it must contain a very specific disclosure in a minimum 12-point font that says your actual rate, payment, and cost could be higher. Get an official loan estimate before choosing a loan. And you can only collect, much like today, you can only collect a credit report fee in advance, which means you cannot even collect a post-dated check or credit card information to use later. And that's actually defined and spelled out in the regulation itself. Purchase borrowers who are shopping, so in your systems, as long as you use property address as TBD, then you don't have that 6th element. You don't have to issue a loan disclosure or a loan estimate. You can use your worksheets, treat them as prospects in your system, convert them to an application when you have that final element. Refinance borrowers who may be interested in refinancing are going to be a little more trickier because they'll know the property address, they'll know or have an estimate of the value. So you have to be careful about when you might capture those 6 data elements. Website applications, you got to take a look at your website applications. Because if you capture those data elements and they hit the submit button, you now, under the regulation, have a loan application that must be disclosed upon. And we all know that, or let me just ask this question. We all get 100% conversion of our web applications, don't we? Sure. So when you have an application, the LE, the loan estimate, must be delivered no later than the 3rd general business day after the application is received. Now that's interesting because they've gone so far now as to have 2 definitions of a business day in this regulation. The general business day means any day that the creditor or the broker is open for business for substantially all of their business opportunities. So that basically excludes Saturdays. Most companies are not open officially for business on a Saturday. We don't underwrite, draw fund loans, or do loan locks, or have secondary marketing activities on Saturdays. Although many times our people work. So for us, the Sierra Pacific, we will not use Saturday as a general business day. That's actually a good thing because if you take an application on a Friday, you don't have to count Saturday. So now you have Monday, Tuesday, Wednesday to do your disclosures. You had to count Saturday, and you'd have Saturday when nobody's might be there, Saturday, Monday, Tuesday. You lose a day. So that's actually a good thing. General business day applies to all the issuance of the loan estimates. The first one and any subsequent loan estimates that are issued, you use the general business day. Now the consumer must receive the loan estimate before they can provide you an intent to proceed. That's very important. And you cannot require, even more important, you cannot require any confirming documentation until you issue the loan estimate. And you can ask somebody if they'd like to provide you check stub or W-2s or the purchase contract, which might be important, but you cannot require that data. So how is the LE received? 3 ways. Face-to-face, obviously, you can provide the loan estimate. There's a place for the borrower to acknowledge it as received. That now reduces all the time frames down, and you can proceed with everything. There's electronic delivery, which we plan to use at Sierra Pacific. The important thing here is that when you do an electronic delivery, you must make sure you get the e-consent documentation signed first, so the consumer is consenting to electronically signing forms. Then you can provide the documents. There's what's called a mailbox rule in this regulation, which basically says the application on Monday, then you have to produce that by Thursday. When you produce it, you may request verifying information, and then the consumer receives it 3 days later and can indicate their intent to proceed. Obviously, this can be shortened, like I said, by acknowledgement from the consumer. So if you're doing it face-to-face or you're using electronic delivery, you can reduce that time frame. So we're going to look at the loan estimate in detail. There's 3 pages. This is page 1. And you'll see as we go through this, actually most of the information that really is important to the consumer is on the first page of this document. So at the very top, excuse me, at the very top of the form, you have information about the creditor name and their contact. Now that's the creditor. If you're a mortgage broker, that's not your name, that's the lender's name. You have the date issued, property address, sales price, loan terms, the purpose, the product, fixed rate as an example, loan type, conventional, FHA, VA, USDA, a loan ID number, and I'll talk about that in a second, and whether it's rate locked, yes or no, and if it's yes, the information around the rate lock. There's a couple of key things that really present obstacle for our industry. The creditor name. Now the creditor name, the regulation says the creditor name can be blank. So the document could be issued by a broker without the creditor name. The problem is they didn't carry that thought process quite all the way through. The loan ID number must be the same throughout the entire transaction. Yes, that does present a problem. Which means the loan ID that's on this very first document has to be the same on the very last document. So that obviously presents a problem. Next section, loan terms. Now here you see the information about the loan amount, interest rate, monthly P&I, if there's a prepayment penalty, yes or no, balloon payment, yes or no. I find it interesting that the CFPB, in their example, which this is coming from, uses a prepayment penalty. I'm not sure about you, but we haven't done one of those in a while. The next section now, you have projected payments. This is a very interesting section because now the form becomes a little more complex. In this example, there are 2 columns. You see projected payments for years 1 to 7, which are principal and interest, mortgage insurance, and estimated escrow amounts. Then you see years 8 to 30 with no mortgage insurance because it's fallen off. Well, the challenge is, this form has to go from 1 column to as many as 4 columns based upon your loan type. If you have a fixed rate 80% loan, you will have 1 column on this document. If you have an adjustable rate arm with mortgage insurance, you'll very likely have 4 columns on this form. So the first challenge for the industry in our technology group is having the form dynamically change, going from 1 to 4 columns. The other interesting thing on this form is if you look at it carefully, you'll see some numbers, P&I have got 2 decimal points, 768.28 I think, but the total payment has no decimal points, $1,050. So the regulation is very specific. Certain fields are rounded up, certain fields go to 2 decimal points. Certain fields can go to 3 decimal points, except if it's nothing but zeros, there's no decimal points. So 3 and 7/8 is 3.875, 4% is 4%, no zeros. very specific in the regulation. Finally, at the bottom, there are two numbers: estimated closing costs, which come from page 2, which we'll look at next, and estimated cash to close. So on this one page, the consumer can see what his payments are going to be over the life of the loan, how much cash, what are his closing costs, how much cash does he need to close, what kind of loan is he getting, and is it rate locked, yes or no. This will probably be the one page you look at. You might not even look at the next 2 pages. But that remains to be seen. Page 2, we get into the detail of the origination costs. So the very top, now, today we deal with blocks 1, 2, 3. Those are gone. Now it's ABC. Don't ask me. Block A, very similar today. Block A, origination charges. These include discount points, origination fees, any costs paid by the consumer directly to the originator or the creditor, application admin, underwriting fees, and there's no variation or tolerances allowed in this box. So these are items that can't change. Now they can change due to a changed circumstance. If a program changes, if the loan amount changes, the borrower goes from a 30-year to a 20-year, those numbers can in fact change based on that. But you can't change and say, gee, my $500 processing fee, I'm going to go to $400 to save the guy $100. No, can't do that. The next box, box B, these are services the consumer cannot shop for. These are things required by the lender or the broker, but the consumer isn't allowed to shop for or pick themselves. These things cover things such as appraisal fees, credit report fees, tax service fees, flood cert fees, etc. The other thing, and I didn't mention it before, because it does apply to all the boxes, the fees, as you can see, are very nicely listed in alphabetical order. That is a requirement by the regulation. It must be listed alphabetically. These fees in this box, services the consumer cannot shop for, have no variation unless through a changed circumstance. That means when we quote these fees, they can't change unless through a valid change circumstance. The next box, box C, these are items the consumer can shop for or can select. Pest inspection fees, surveys fees, title insurance, buying title settlement side of the business, and certainly the real estate sales professionals in here know that one title company or one settlement agent will have one type of fee, another type of fee over here. Might be courier fee over here, might be delivery fee over here. Well, whatever we call it here, we have to call it all the way through the transaction. Well, that's not that hard to do, except let's look at the process, and we'll talk about this a little bit in a minute, but I think it's important here. In reality, your mortgage brokers, your mortgage lender partners, they have pre-qualified your borrower. They have quoted some fees, some costs. They get the call Friday night. Hey, meet me in the morning. Our offer's been accepted. Let's go. So they now have 3 days to produce that LE. They cannot require to receive a copy of the purchase contract before they issue that LE. In reality they can get it optionally. They could call their real estate partner and get it, but they can't go to the borrower and say, you have to give me a copy of the purchase contract before I can do this document. Can't do that. So they can't produce the LE, but whatever they name those fees are going to have to be consistent. And that's going to be a challenge, and we'll talk about that a little bit more. Then at the bottom is box D, which is just the total of A, B, and C above. Then we go to the other side of the form. Start with E. That's your recording fees, any other taxes paid to the government, transfer taxes. Now you'll see here, there are no transfer taxes on this particular form. And you'll see when we look at the closing disclosure in a few minutes, that there are transfer taxes there, but they were paid by the seller. So transfer taxes only appear here if they're going to be paid by the buyer. Then you have prepaid items. Your prepaid items mainly are homeowners insurance or possibly mortgage insurance. Obviously prepaid interest, which everybody knows, covers interest on the loan from the date of closing up to the end of the month. Next section is escrow impound amounts that would be collected at closing. Any other costs would be listed under H. Here's an interesting little thing. You see title, owner's title policy, optional. Regulation has defined that if there's owner's title policy, which is different than the lender's title policy, it has to be shown in this section, has to be shown as an optional coverage amount, and it has to be shown at the full cost amount, not the discounted amount. Because we all know that if you're purchasing the LTA policy and the lender and the owner's policy at the same time, you know, our title partners are very nice and give us a discount. Pass that discount along. We can't show it that way. We gotta have to show the full amount here. That's gonna be a little bit of a challenge. And then finally at the bottom, you have I, which is a cost of a subtotal of these costs. So you see that if there were any lender credits on the loan, if there were premium pricing and there was a credit going back to the borrower to pay some of these costs, that credit would show right here and reduce that $8,054 by the amount of that credit. Then you have the calculation of the cash to close. Again, you'd have any credits coming from the seller would show here. And this estimated cash to close, 16,504. If you turn back to the first page, you'll see it matches that page. Page 3. Now we get into some additional information at the very top of the form. We have the lender, creditor information again. But now we would have any mortgage broker information would be here. Both the mortgage broker name and the company NMLS number, as well as the individual originator, their NMLS number. I always have trouble saying that. Their email and their phone number. And that ends the presentation. Time for break. There we go. So now the next little section are some comparison data, and there's some new information in here. First we have to show the total interest, the total payments for 5 years, totally paid in principal, interest, mortgage insurance, and loan costs, and the amount of principal that they have paid off on their loan. The APR now shows here, so that the truth in lending form is gone. Till now shows here. And there's a new calculation called total interest percentage, or TIP. So here's the formula. Everybody, you know your borrowers are going to want to know this vital data. It's the total interest paid over the life of the loan divided by the loan amount. So those of you that are ADD like me said, well, I want to figure this out. So I took the P&I payment times 360. I subtracted the loan amount, said, all right, there's my interest paid. Divided it by the loan amount, I could not match that number. Well, but you got to think about it. You got to back up a page, because if you go over here, right here. Whoop, where'd it go? There it is. Prepaid interest, $17.44 a day for 15 days, $262. When I added that in, then I matched that number. So if you're doing a loan for an engineer from IBM or Apple or whoever, they're going to want to know. So that's how you figure it out. Then at the bottom, some more disclosures. Appraisal basically said they get a copy of the appraisal. Is your loan assumable? No. Homeowners insurance? Yes, you need some. Is there a late payment? And when it's charged and how much it is. Refinances. Yes, you can refinance, but don't count on it. Servicing. Don't you think we all should have had that disclosure in 2007? And servicing, do we tend to service or do we transfer at all? But why this is important is if we list these people, these providers, if they select somebody that we've listed here, which they certainly can do, then we have a 10% tolerance on our quote. I.e., if we're telling them to use this, they can use a service provider, and then we should know what those fees are. If they select somebody not on this list, then there is no limit on the tolerance. So if we provide a service provider list prior to having the loan, the purchase contract, and we say, just name your name, I'm not advocating anybody. If we say Fidelity National Title, and they pick, Stewart Title and a local settlement agent, hey, that's fine, but then we just use their fees, and of course there's no limit on any variance to that quote. That's very important. The other thing, if you look at this, you've got it there in the handout. Obviously, it's the service provider, the estimate of that cost, the name of the provider, and then contact information. And you need to provide somebody that can provide services in that area. So, unfortunately, I can't use Charlie's Termite Company in San Diego for a loan in Maryland, because I don't think Charlie's going to drive 3,000 miles. Again, okay, sorry. I can show you where to get it. Look at the end. The other thing is, of course, just like the other things, must be listed alphabetically. There's a lot of consumer research here, not by us. All right, let's talk about some of the challenges in the implementation of the loan estimate and the process. So now we have tolerances, which are now referred to as variations. So tolerances, variations, kind of the same thing. So fees that cannot change between the time we issue the loan estimate and the time we do the closing disclosure. Creditor, mortgage broker fees, transfer taxes, fees paid to an affiliate of the creditor or the mortgage broker. That's important. And fees that the borrowers cannot, services the borrower cannot shop for. Those cannot change. Fees that can increase by 10% in the aggregate, recording fees, third-party fees for which the consumer may shop but not paid to an affiliate, and finally fees that can change without limit but that were estimated in good faith, prepaid interest, property insurance premiums, impound reserves, third-party service providers selected by the consumer and not on our service provider list, and services not required by the creditor. So things that the borrower wants to obtain, like a home warranty, we obviously have no control. They've selected the service provider. That can change. We must provide these costs with the best information reasonably available, and that's a standard that's outlined in the regulation, and they must generally be the actual terms of the transaction. The way the regulation is worded, they define did you use the best information and did you produce this loan estimate in good faith? They define that by saying if the costs at closing are the same or less than what you disclosed, then you did this loan estimate in good faith. But it also means you can't pad, and just add fees willy-nilly. And you can't guesstimate. So, and the systems must be capable to capture all the information required to produce. You saw some of the information. We have NMLS numbers now down for the broker and the originator. We have service provider contact information. We don't capture that data today, and we have to have our systems available to capture that data to produce this document. And it gets even more complex when we get to the closing disclosure. The rounding I touched about earlier, but some fields are whole numbers, some fields go to 2 decimal points, some go to 3 decimal points. Some go to the nearest whole dollar, others are rounded to the nearest dollar. And of course, again, any affiliate company arrangements, there's zero variance. So the broker may produce the LE without a creditor's name. I mentioned that earlier. But there's some challenges. So you have a risk that the creditor may not accept that loan estimate. You know, just like today, you produce a GFE, the GFE may or may not be accepted by the creditor. You have challenges with the names used on the fees because the names have to be consistent from the start to the end. And there's challenges with that loan ID number I mentioned. Now you can produce an LE with a creditor's name, and so what's likely to happen, what our approach is, and I know several other wholesale lenders' approach is going to be, is we'll provide you systems and access to input data and produce the LE on your behalf. So that will keep our fees named the same, put a loan number on the form that will remain the same, and make sure it's accurate for both you and us as creditor. In either case, timing is going to be critical because we only have 3 general business days. Today, you know, as you know, our process is you can provide the GFE to your customer. A couple days go by, maybe 1, maybe 3. You submit to us, you come on, you register the loan, you give us some data and information, and we can accept or not accept that transaction at that time. We don't have that much leeway now because it all will be driven by the date of your application, not the date we receive the application. So that's an important change. And the websites, as I mentioned earlier, you should review those because if you capture those 6 data elements, you have to produce the loan estimate. That's important. I know that some lenders, if you go to Bank of America's website or even Wells Fargo's, you'll see that they don't have an online application anymore. You can put in some information and they'll call you and work with you to complete it, but you cannot apply for a mortgage loan online at either of those 2 institutions. Broker's compensation is not disclosed on the loan estimate. That's a little bit of a change. If you're doing a transaction with borrower pay compensation, that is disclosed on the loan estimate. The accuracy is ever more important. You know, updates to all our parties, all the parties involved, all of our partners in a transaction. It's very important to keep that information flowing. Closing agents are going to become involved earlier in the process. And of course, real estate agent, our partners have to be vested and understand the process of the transaction. Because when there are addendums to the purchase contract, everybody needs to know, not just at the closing table. Now, I can't stress this enough. We're going to see, the borrower's going to see 3 to 4 of these LEs during the course of the loan. At or just after application. When a purchase contract is received, there'll probably be a new LE issued. When the rate lock is done, and of course, anytime there's a changed circumstance, we'll have to provide a new LE. I just can't stress collaboration. It's so important. And it's even more important as we look at the closing disclosure. This is the second new form that's going to be required. Now, what the closing disclosure does is it combines the truth of lending and the HUD-1 into a single document called the CD, or closing disclosure. The biggest change here is that the CD must be received by the consumer 3 days prior to consummation. So before any other documents are executed, the borrower must receive the closing disclosure 3 days prior to that date. Once you issue the CD, you can no longer issue a loan estimate, and changes to the CD can be done without a new waiting period. 3 situations. If a loan program changes, probably not likely. If you add a prepayment penalty to the transaction, again, very unlikely. or if the APR becomes invalid and changes by more than an eighth on a fixed rate loan, more than a quarter on what's called an irregular loan, which really is most ARMs, those circumstances would require a new 3-day wait. A new 3-day waiting period is not going to be required if there's a final walkthrough and the dishwasher doesn't work and the seller says, I'll give you $500 credit at closing to compensate for the dishwasher. Not a problem. We do need to produce a new CD, but there's no new waiting period. So little nuanced changes at the closing table like that are not going to trigger a new waiting period. Now, if you go through the walkthrough and suddenly there's a $2,500 credit, that could trigger a walk back through underwriting at a minimum, because there's obviously changing the terms of the transaction. If they change the loan amount, if they change the purchase price, that's going to trigger some different things. But generally speaking, the minor changes that can occur at the closing table, are not going to impact us and have a new 3-day waiting period. So the lender is responsible for the data and the accuracy of the CD, which really means the lender is going to prepare the CD in collaboration with the closing agent. The closing agent is not going to prepare the CD, not going to prepare a HUD-1. The closing agent will likely prepare a closing worksheet. ALTA is a recommended document to use. They will prepare that. But the lender, in almost every circumstance I've heard of, is going to prepare this document. You have to provide the document to, if you're doing a refinance, any borrower that has the right to rescind has to be provided the CD 3 days prior to closing. Consummation, I'll come back to that. And on a purchase transaction, only one of the primary borrowers needs to receive it. So if you have a husband and wife and the husband acknowledges receipt, you're good to go. But he has to acknowledge that receipt and have it 3 days prior to consummation. CD does show greater detail around the closing costs and who is paying those costs. We'll go through it in detail in just a minute. And at this point, the broker's compensation is reflected on the CD, even if it's paid by the lender. And of course, we must redisclose if the terms and costs of the CD change or become inaccurate. It doesn't necessarily require a new 3-day waiting period. So timing's everything. So if your closing date's on a Tuesday, working backwards, disclosures are due to be received the preceding Friday. Now here's where a new definition of business day comes into play. There's a definition in the regulation called specific business day. This definition does count Saturdays. Now that works in our favor, which means, if we were not able to count Saturday in this example, he would have to receive those documents on Thursday. Because we count Friday, because we're to count Saturday, he will receive them on Friday. Then you have Friday, Saturday, Monday. He can close. The loan can be consummated on Tuesday. So it's important that you need to kind of look at your transactions and start working backwards. And in California, it's worse. I'm sorry. Because we're a quote-unquote dry state, which means, of course, we're without water. But it also means you execute the documents and then you get the money a day or two later. In wet states, everybody comes at once, everybody signs everything, and the money's there, and everything happens at once. Done at once. That's an advantage in other states. So if working backwards in this transaction, closing date really might be Thursday, because they're going to sign their documents on Tuesday. They'll be returned to the lender, who could fund anywhere from Tuesday through Thursday, depending on what wants. So it's very important to work backwards and look at those dates. I don't want to scare anybody, but those of you that are in the origination side of the business, think about your loans that are closing funding today. and then work backwards with this calendar and go, gee, that would have meant it would have had to receive the closing disclosure notice sign. So it's important. So let's take a look at the closing disclosure in detail. You'll see that the first page looks much like the first page of the loan estimate. The very top box, there's a little more detailed information. You have closing, you have date issued, closing date, disbursement date, the settlement agent's name, property address, borrower's seller name, the lender, and some loan information. One good thing here is, unlike today's documents, there's no rate lock expiration on the closing disclosure. So those times, given the market, if you have a rate lock extension at no cost or minimal cost, it doesn't move that APR, doesn't trigger a new disclosure, doesn't trigger a new CD and a new waiting period. Let me back up. The rest of these sections, loan terms, the payment information, the impound information, closing costs, cash to close, all are just like on the loan estimate. So those are the same. It's only this top little box that's got a little more information in it. Page 2, that's where we come to the closing costs, just like on the loan estimate. Page 2 on the CD is the closing costs. Now it looks different, and it has a little more detail. You can see that there are columns here: borrower paid, seller paid, and paid by others. The box A, B, C, etc. mirror those of the loan estimate. So a consumer could go back and look at the document, the loan estimate as a CD, and compare box to box. What they also do show when they're paid at closing or before closing and who has paid those. I keep pushing the wrong direction. The next box, services the borrower did not shop for. Here we can see where the appraisal fee is out in the final far column. That was paid by others, likely the lender. Then you have the cost paid by the borrower and when they were paid. The credit report fee was paid prior to closing. And then the other fees were paid as at closing. So again, these are services the borrower could not shop for. And again, just as on ELE, must be listed alphabetically. Don't forget. The next box, box C, services the borrowers did shop for. Again, listed alphabetically, and of course, who is paying those and when were they paid. All costs paid to a closing agent or title underwriter start with the word title. And again, owner's title. The title is not listed here, it's listed under other. Then there's a box D, which again is the subtotal of A, B, and C. The next section, you have other costs. There you have your recording fees. And you'll notice the recording fees have a little more detail, deed and mortgage. Here you see the transfer taxes, but they're in this paid by the seller column. And then you have the prepaid items, homeowner's insurance, mortgage insurance, prepaid interest, etc. Well, I gotta learn how to work this thing. The next box, you have initial escrow payments, just like on the LE, and the other fees. You can see quite a few other fees listed here as they became known. And of course, we have things listed here: real estate commission paid by the seller. Then you have a subtotal of those costs. Then you have subtotals of all closing costs along the bottom, and of course any lender credits would appear here as well. And the owner's title is also listed here as optional. Page 3, now we have the calculating the cash to close. Here it's comparing the loan estimate figures with the final CD figures. It shows closing costs, down payment, deposits, seller credits, and other credits. You'll see the very last item is adjustments and other credits. Those come from a couple other sections I'll show you in a minute. Which now you have a section of form that looks like the old HUD 1. But you can see that there's a HOA dues of $80 paid by, as an adjustment paid to the seller. And here in the next section, you've got some more information, but here you see other credits. Here's where you see the credit from the title company for the discount purchase of the owner's policy. So that's how we reconcile the final cash to close. The discount appears here. And prorations around the taxes, and finally at the bottom, calculate cash to close for both the buyer and the seller. So this document is going to be prepared by the lender or the creditor. So obviously there's lots of data here that we don't capture today that we'll need to get from our settlement agent providers. Page 4, some more information about the loan. Again, the assumption, demand feature, late payments. Does it have negative amortization or not? Does the lender accept a partial payment? It has escrow account information, including non-escrowed items such as homeowner dues. Page 5, much like the last page in the loan estimate, again, we have the total payments, the finance charges, the amount financed, the APR. We have our friend Tip again. I need to get Tip. The more disclosures about the appraisal, contract details, liability after foreclosure, whether there's a right of redemption or not. Again, refinance, tax deductibility. There's another little key block on that form. It says questions. It says, if you have questions about the form or the loan, you can contact any of the parties below. And if they don't respond very well, you get a hold of the CFPB. We'll help you out. So just telling you guys, take care of your borrowers. And then at the bottom, now you have all the contact information around the lender, the mortgage broker, the real estate broker, both buying and selling, and the settlement agent, name, address, San Diego escrow. So you'll come to our website, you'll say, hey, I got a changed circumstance, I got a different service provider. Great. You can get a hold of them and get their quotes and give that to us. We'll produce the revised LE.
So the revised LE section B can be revised?
C.
But just C?
Yes.
But I can't revise section B, flood termination?
Yeah, yes. You can't revise B unless something else changed. Okay, so go ahead. So, all right, so the question is, I'll finish the question I've had before. So you have appraisal fee and credit report fee in the section that can't change. But we all know in reality, things change. You have borrowers that, the biggest one that changed is the appraiser. You quote $450, whatever standard fee is, and you find out that, gee, it wasn't really a single-family residence. It was, basically a hobby farm on 10 acres. And the appraiser calls you and says, I'm not doing this for less than $800. That is a changed circumstance. You now have new information. You can revise that quote. We'll want something from the appraiser, obviously, but that is a changed circumstance. Now, I'll give you an example of what isn't a changed circumstance. You fat finger the keyboard and put in $300 for the appraisal fee, and it's always $450. You're stuck. And the same with the credit report fees. You get a credit report, you get your credit report up front, you do your pre-qual, the guy gets his house. Now the underwriter comes back and says, I need a supplement to the credit report. All right, that's $50. Well, that's a changed circumstance. The underwriter required it. Boom, new LE.
Will you provide the things that aren't here for us? That are
absolutely.
Good.
Whatever that is.
Yeah, no, there's several of those that aren't in our handouts.
Yes, I'll work with Linnell and they'll actually get a copy of the entire presentation.
Thank you.
Yes, the question is, does the 3-day waiting period for the CD include Saturdays? Yes. And you gotta be careful, if there's a federal holiday in there, it throws everything out of whack.
If the seller is selecting services, if the seller is selecting the services, but the buyer is paying them and is allowed to shop for them because he's taking the loan, does the buyer actually accept the service, select the services, or can they?
Yes, they can.
Okay, so the seller could not force you to use their services?
Well, the seller can. That's between the buyer and the seller. That's buyer and seller negotiation. We got one, now we'll get to the back.
Regarding a refinance, as far as the timing, is it now a dual 3-day?
It is 3 plus 3. So the right of rescission doesn't run in conjunction with 3 days, because you have to get the CD 3 days prior to signing the note. And of course, then the note, once you sign that, there's a 3-day rescission period.
In a purchase transaction, if you have the buyer and seller negotiate on a closing cost credit in lieu of repairs, that's going to require a new LE? Yes or no?
Well, it depends when that information becomes available. So,
Typically, that's done probably a couple weeks into the transaction because you're doing a home inspection.
sure.
Find
Yeah,
out.
so you're processing your loan, it's going around, hadn't gone to underwriting yet, and now all of a sudden there's a $1,000 credit, then that's a changed circumstance, and we just produce new LA.
And then you say, I think the waiting period, is there always 7 days after the LE has been provided that you can't close?
Well, that really only that's only that first period. In other words, you cannot close a loan sooner than 7 days.
Okay.
I didn't really touch on that. It's in the presentation. I didn't touch on it because, can you close a loan in 7 days? No. Let's be realistic. Well, that's not a loan. We gotta get to the back of the room.
Regarding the yield spread premium, lenders paying the broker's fee, where's the broker's fee disclosed?
The brokerage fee is not disclosed on the LE. On the CD, it would be in block A, and it would show as paid by others.
Paid by others, okay.
Okay, so the question is, yeah, so the pricing, let me try it this way. So the pricing on the rate sheet is 103, of which you retain 2. So the credit to the borrower is 1 point. So 1 point, let's say a $200,000 loan, you'd have a $2,000 credit in section J, and then you'd have $4,000 as lender paid compensation paid by others up in A.
So it's not
So
disclosed on the LE.
it won't total into his costs, but he'll see this $4,000 as being paid by the lender.
Okay, this side, here we go.
Okay.
The corner.
Oh, yep.
Okay, so let's talk about realtors for a minute, because I'm kind of fond of those people. How is this going to affect loan contingency removal?
So how will it affect loan contingency removal? Probably not. So usually loan contingency means you want a loan approval. So the only impact is going to be in that initial providing that LE and getting their intent to proceed. So if it's mailed, so let's say that you have a borrower that doesn't accept electronic signatures. So basically you produce that LE, you gotta wait 3 days. Borrower goes to a lender or a broker, they run a credit report, they might run them through an automated engine, they get an approval that basically says, yeah, you're approved, your credit's good, your income is good, you know, your assets look good, but guess what? That's just data. Now we need the verifying documentation. So then that verifying documentation is assembled, check stubs, W-2s, tax returns sometimes, bank statements. That all comes together, is reviewed by an underwriter who says, yep, everything's good. Now what can screw that whole process can get screwed up with, you don't get a check stub, you get a statement of earnings, and you don't get a W-2, you get a 1099, and you get a tax return that's got $25,000 in business expenses, and you get a bank statement that's got a $40,000 deposit 2 days ago. Those have all got to be explained and looked into. So that's what pushes things out.
Hello.
Yes?
Okay, back to the LE, I have 3 questions.
Okay.
A, C, and E. So block A, I'm a contract processor, so where do I put my fees?
Well, your contract processing fee would be in box probably B.
Right now, we do an A in GFE, right?
If you do it in A because your contract processing services are paid by the broker, or do you get a
No,
check?
I get directly from escrow, the client paid for it. Most lender allows that.
Should be in B. It's a service that the borrower cannot shop for. Just like an appraisal fee.
All right, and then C, where it says 10% tolerance, does that mean it only can go up 10%? What about lower?
Oh, it can go as low as you want it to.
Okay, got it. That's good to know. And then E, where it's the transfer tax, you said only disclose if it's paid by buyer.
Yes.
But most transfer taxes in Southern California is paid by seller.
Then you can leave that blank. So here's the challenge. So if it's customary, Southern California, the seller pays it, you leave it blank. The purchase contract comes in and you don't catch it. Happens that there's a little statement, buyer and seller agree to split the transfer tax. But once you get that information, that's a changed circumstance. You can redo the LA.
Well, is it a good idea to always disclose it anyway? Just for
It's
the
not
heck
a
of it?
bad idea, because that way, if it's paid by the seller, lower is always better.
Okay, thank you.
Actually, a 2-part question. Number 1, I think I know where I put it in, but as you know, there are developments that have private transfer fees. So I'm assuming that's going to have to be in the LE as well, disclosed, because we know what they are ahead of time.
Yeah.
And is that going to be B, because buyer can't shop for it?
I would think it would be in B.
Okay.
I might want to get back to you on that.
Yeah, because you do have that, that's on many of the properties that have actual private transfer fees. My next question has to do with a time of funding when we get last minute prior to fund conditions. One of them that usually comes up has to always do with insurance, and suddenly there is a realization by the underwriter that they feel there's an inadequate coverage on the insurance, and so therefore the insurance cost will go up. What happens at that point in time, and how long will that hold things up?
It shouldn't trigger a new 3-day wait. It will certainly trigger a quick review by an underwriter, make sure that the payments, that the debt DTIs are still on.
Okay.
But it's not going to change the APR. So you're not, worst case is you get a new CD, but no new 3-day wait.
Okay, great. Thank you. And you'll get back to me on the private
Yeah.
fees. I'll give them the card. Thank you.
Hello, I'm on a contract processing side also. I have a question in regards to the fee on a purchase transaction. As you know, all the fees have to be included in the good faith estimate. But on this loan estimate, once you get those 6 items, you have to send this out. Then you would have to send another one out once you get the actual fees from the title company, title and escrow?
Well, that's a yes and a no.
Come on, I need one
Okay,
better.
so here's the no.
Okay.
If we issue an LE and we say Fidelity National Title and they pick Fidelity National Title, we got to live with that. If we issue it and it says Fidelity National Title and they pick Stewart, then we can change.
And I have another question, only because I prepare the initial applications and disclosures. So this has to go out first. 3 days later, I can send out my total initial application and disclosures that includes my intent to proceed to be, and then the hard copy date on those applications and disclosures has to be 3 days after this one?
No, your application should be dated first.
Okay,
And then the regulation also is a little specific about what goes out and when. So they don't want a 70-page PDF to be sent to the borrower with the LE in there somewhere. They want the LE and the service provider list separate. Then you can have your intent to proceed and all your other disclosures. Depends on when. It can be, you can send that all basically same day in 3 separate communications. They just want to make sure it's, the LE isn't part of 70 pages of other stuff. All right, in the back.
I'm just curious.
So am I.
On an owner-occupier or owner carryback, would any of this be required?
Private second, probably not.
Private first?
No.
Okay, perfect.
Now, you might want to do a little research in the regulation, because if you have somebody that's doing private first, like 100 of them a year, then they're probably going to be part of this. But really, it's probably not, they're probably not going to have to worry about it. Thank you. We have an attorney in the room.
You had said that you don't have to have a lender on the front page, but then you said that would be weird with the loan ID because it has to match all the way through. Can you not have a loan ID?
No, you can't. You gotta have a loan ID.
Okay, and then
I will say this, there is some ambiguity about that.
and the seller's portion of the title policy.
Yes.
Perfect, thank you.
Over here on the left. I just want to follow up on that last question with regards to the loan ID. Over here.
Oh, there you go.
I guess my left. So as being a loan broker, a lot of times we have a lot of options like Sierra Pacific, and we don't really know where we're going to send the loan. So I'm assuming that having a loan ID number start to finish is going to be somewhat of a challenge. So I'm assuming, I'm just thinking out loud here, is the fix that we're going to go to, we're quoting a borrower when we have the 6 pieces of information, going to 2 different, maybe generating an LE from Sierra Pacific and issuing that to the client, and then also doing another LE with another bank with a separate ID at the same time. It seems like it would be the only logical thing in my mind that you would be able to offer the borrower a choice or some sort of a backup. Is that what you guys are seeing is going to happen, or is that something that we're not allowed to do?
Well, unfortunately, we believe that will happen, which means we will be doing work for transactions that will never close. And that is a concern to us as a lender, just sheer volume of workload. But that very well likely will happen. Now, what could also happen is some of that research is done in advance of identifying a property, so that you're kind of honing in on where you think, because it's not just rate and fee, it's, there are underwriting considerations that vary lender to lender, and so that can be a determining factor as well. So I think you'll find yourself working a little more closely with your lending partners. But I'll tell you, it's going to be a struggle for all of us, and unfortunately, there is no phase-in period. One question that I'm usually asked, but haven't been asked yet, is, is it going to be delayed? No. It is not going to be delayed. Now, what may happen is there could be some, oversight phase-in, some lender relief if you're making good faith estimates to comply as far as enforcement action, but there will be no delay. I mean, this is a challenge for everybody, and I'm telling you, we're going to work through it, and we're going to figure things out as we go a little bit in August and September.
And then one follow-up question quickly on the second page of the LE under section B. I have a note here that you said that these fees cannot change. So if So it can't even go down?
It can go down.
Oh,
Down
okay.
is always fine.
All right, that makes me feel a lot better.
Yeah. So for example, so let's talk appraisal fee. So let's say a third of the time you're doing a rush appraisal fee and that's an extra 100. Then quote them all with a rush fee of an extra 100 or whatever it is. And if it's lower, yeah, you're fine. It's just as long as you're in, don't quote an appraisal fee of $2,000, when you know it's going to be $450.
This is Woody Henderson, American Dreams
Hey,
Real Estate.
Hey,
You had touched
thanks for
upon.
coming.
Thanks. You touched upon the pre-approval letter. You kind of glossed over that. What's the plan for providing pre-approval when we're just working with our clients in the field, trying to get our offer in and with credibility up front?
So, we will, that's kind of a Linnell question because, today if we were asked to do pre-approvals, quite frankly, we wouldn't be really in favor of that with today's volume. But, going forward, it will probably be something we'll do more of. I mean, you can always come and access the AUS engine, do your credit report, run your AUS, have an idea of what your borrower can look for. Of course, the challenge is they come in and you run them for a $300,000 loan and everything's great, and then they come back and tell you they just bought a house for $595 and they need $450 for a loan. That's the challenge. So, I think the most important thing when you're talking to borrowers about pre-qual and doing pre-approvals, at that point, you can say, well, if you want me to do a pre-approval for you, give me a month's worth of check stubs, give me your W-2s, let me see your bank statements, and look at the documentation, make sure it all makes sense. I mean, back in the old days, when we had IBM Selector 2s, and I sat across the kitchen table taking an application from somebody, in my mind, I knew, all right, they need X amount of dollars, and they need to have X amount of income and X amount of assets. And invariably, I'd get the assets, and I'd say, well, did your agent give you an idea about how much money you need? Yes. Well, before I can finish your approval, I need to verify that. And you need $3,000 and you only got $200. Where's the rest? So it hasn't changed
Hey,
in a gazillion years, please.
on forward locks, when you talked about it, to be able to do forward lock, do we need to have the LE signed or sent out?
No,
or?
it's just going to need to be done. So, for example, we envision this process. You'll come to the website, you'll register a loan, you can run the AUS, do the RALOG, and order the LE all at the same time.
I've heard a couple people talk about contracts are going to change, and I don't understand why. The only thing I see that, other than closing date, as far as the realtor side, the contracts are going to be pretty much the same.
You're probably correct. What will likely change, and does that answer your question?
Yes.
No, what's likely going to change is we're not going to want you to issue the LE with our name on it unless you're doing so through our engine. So that really is the only likely change. Yes.
Okay, so I have a question about requiring documentation for pre-approvals. I think you said for the loan estimate, we cannot require them to provide.
Correct.
But for a pre-approval, we could have gotten it before for the pre-approval?
So let's say, are you a mortgage broker?
Yes.
So you have a little policy that says, hey, borrower wants to be pre-approved, this is the process, and this is what we need. Check stubs, W-2s, bank statement, credit report, AUS. That's fine. This law or regulation does not eliminate the ability to pre-qualify and pre-approve people. But
And send the application out as one DocuSign, and the LE and the service presider as another DocuSign, and they can be signed on the same date, but they want them in separate PDFs?
Yes.
Okay.
Well, you could have separate documents within one communication, but you don't want to put them all in one giant PDF.
So with DocuSign, you can bring in the PDFs and separate them, and that's fine, as long as we
Yep.
send them to the lender in separate PDFs.
Yeah, because the lender, the first thing we're gonna ask you, you gotta come to our website and want us to produce an LE. The first thing we're gonna say is, when did you take the application? Because if you took the application on May, 22nd, and you're coming in on, June 3rd, we're not gonna look at that as being in compliance.
Okay, and then do we issue the LE, will that come from our originating software? Is that gonna be built into it now?
It'll probably come from our service.
Okay, so if I take a loan application prior to knowing which lender I'm going to use, how do I generate a loan ID?
Well, that's the challenge. Because the loan ID you use has to be the same throughout the transaction, and unfortunately, I'm not gonna like your loan ID.
Okay, so if I use a loan ID, what am I making it up if I don't have a lender? Or if I pick you guys and then you can't do the loan because of some unforeseen circumstance, is that a change of circumstance and a new LE is issued for another lender?
Yeah.
Okay, and then on section C, on services they can shop for, when you're saying that they have to be the exact name for the title companies, is this gonna force the escrow companies to lump all of their document drawing and e-sign fees all into one fee?
Boy, wouldn't that be great?
Right.
There are companies that are working on doing that, doing a single fee quote, and it would just make everyone's life a lot easier.
Okay, and then two more questions. One on the servicing box on the LE. Is that from a broker side or from the lender side?
That's from the lender side.
Okay, and then the last question is on the closing disclosure. There are 90% of the escrows we use do never disclose the seller's proceeds, and a lot of them won't disclose on the final HUD the amount of commission, and it's flat out staring the buyer in the face. Do you anticipate some fun lawsuits down the road for privacy disclosure issues on this?
Well, remember my disclaimer? I am not an attorney.
Bless you, thank you.
Yeah, the buyer will not receive the seller's portion to show proceeds. They can, who cares? I mean, I owned it free and clear. I sold it for $1 million. Lucky me.
Your original estimate here is based on a cost, not a rebate or yield spread premium.
Well, there was no broker involved. That's an example from the CFPB.
Without a broker involved.
That's correct.
If there is a broker involved, and if the broker is doing a lender paid, there's not going to be an origination charge at the top?
There would, if there was no origination charge, it would not be there.
So if it's lender paid, then our fee is not going to show up.
Your fee will not show on the loan estimate.
But the credit for the yield spread will still show as
Right. Yes.
As a correspondent, getting back to the loan number thing, if we use a loan number for us and then we
That's
sell
the
the
one
loan.
you use.
Okay, so that will carry
Yeah.
through and then no
You're a
problem.
correspondent lender, we're buying a closed loan from you, that's your number.
There we go, thank you.
In the back?
Yes, when you read through those 1,800 pages,
1,880.
1,880 pages,
Skim.
did you see anything in there about the service provider list that we have to provide actual written quotes from the service
No,
providers?
you don't have to provide written quotes.
Okay, I was
But-
told you did.
No, you don't, but whatever you do quote, you live with.
You're going to be the ones that provide the list.
We are anticipating that as the process. In the back?
You just talked about the lender paid compensation and the YSD credit. You're saying that on the loan estimate, the YSD credit will need to show, is that correct?
Okay, yes.
But the mortgage broker compensation will not because it's lender paid. So the question is this going to show the net then? Or
Yes,
does
it will show net. So in other words, if the premium before your commission were $10,000 and your fee was $8,000, then there's only $2,000 available to the buyer to pay out of the costs. That $2,000 is what will appear as a lender credit.
Okay, thank you.
I really need a bathroom break.
Gary?
Yes?
If we have the borrower sign the LE at the time they're sitting down with us, can they sign the intent to proceed straight away?
Yes. So so the keys are, you produce the LE, you can ask for documentation. They sign the LE, you can ask for the intent to proceed.
Thank you.
So they can sign it both at the same time. Question right here in front.
Compensated? Okay. On an appraisal fee, as a broker, we pay it up front to get the job done. And then,
Get reimbursed.
we expect to be reimbursed at closing. How is that handled on the document?
Well, it would still be under services they can't shop for. Can I take a bathroom break? Let me take a bathroom break. I'll be back in a few minutes. I'll answer more questions if you're here. Otherwise, I really do thank everybody for coming today.